Now, when we talk of a group cash flow or any cash flow, this is a financial statement that will show the movement of cash in and out of the company. Like, for example, in the company, you can give me the P&L statement, profit and loss statement there. For example, you tell me that the profit for the year is 200 million. 200 million. You tell the shareholders that profit for the year is 200 million. But at some time, when they ask you this 200 million, you will not have even maybe any money. For example, you can generate the profit of 200 million, but when we go to your bank account, you have an overdraft of 30 million. Overdraft of 30 million. But in your profit and loss, you are telling us that during the period, we generated the profit of 200 million. Therefore, these things used to bring a lot of conflict between the directors of the company and the shareholders, between the management of the company and the shareholders. Therefore, that is why the standard setters brought in the cash flow statement. Therefore, you are telling me that the profit is 200 million. Show me why I have an overdraft of what? 30 million. Why do I have the overdraft of 30 million? Therefore, in our cash flow statement, we are going to show the movement of this 200 million, how we generated the 200 million, and how we spent the 200 million in our business operations, Therefore, you say that a cash flow statement, you introduce and say, a cash flow statement is a financial statement. A cash flow statement is a financial statement, that summarizes cash and cash equivalent, cash and cash equivalent, entering and leaving the company during the period, during the year. Cash flow statement is a financial statement that summarizes cash and cash equivalent entering and leaving the company during the year. Then you say the cash flow statement measures how well the company, the cash flow statement measures how well the company manages its cash position, manages its cash position, how well the company manages its cash position, meaning how well the company generates, cash to pay its operating expenses, how well the company generates cash to pay its operating expenses. Then you put another dash and say, cash flow statement is divided into three parts. Cash flow statement is divided into three parts. Number one is operating activities. Number two is the investing activities. Investing activities. Then number 3 is the financing activities. Financing activities. Cash flow statement is divided into 3 parts. We have what we call the operating activities, investing activities, and financing activities. Let's begin with operating activities. Operating activities. Operating activities, we say, this represents cash flow from routine principal activities of the company. Routine principal activities of the company. This represents cash flow from routine principal activities of the company. For example, you are a supermarket, for example. The work of a supermarket, you buy goods from suppliers, you stock them, you display them, you sell them. That is your core activities. Those are your core activities, principal activity. Therefore, there you are operating. For example, you are a manufacturing company. You buy raw materials, you manufacture finished goods, then you sell to customers. That is your core principal activities. Therefore, there, the cash flow that rotates in those buy of raw materials, production of finished goods, that way we say it's operating activities. Then number 2, this represents cash flow from our routine principal activities of the company. And cash flow from operating activities are made available for investing. Are made available for investing. Therefore, whatever we are getting from operations, we do a long-term investment. Then we go to number 2, investing activities. Investing activities. This represents, we say this represents cash flow. This represents cash flow from transactions of long-term investments, e.g. purchase of assets, e.g. purchase of asset, acquisition of a subsidiary, associate, etc. This represents cash flow from transactions of long-term investments, e.g. purchase of asset, acquisition of subsidiaries, associate, etc. Therefore, in investing activities, we are making available the money from operations to invest them. Because when you receive cash, that is the profit you are receiving. You don't just give it, you invest. You invest as a company, you invest. Therefore, that cash flow is made available for investment. Then we go to last, which is financing activities. Financing activities, we say, this represents cash flow to and from the owners of the company. This represents cash flow to and from the owners of the company. Of course, the owners of the company are the shareholders. Therefore, these shareholders will be giving us money they buy shares, they increase their shares, they give us money, and also we pay them dividend. When we pay dividend, it is cash flow to the owners of the company. When they invest in the company more money, it is cash flow from the owners of the company. Therefore, we can also generate cash from the owners of the company. Those cash that we receive from the owners of the company comes under financing activities. Under financing activities. Up to there, I believe we are together up to there. We now know that the cash flow is divided into three parts. We have the operating activities, investing activities, and financing activities. And we know what happens in each activity. Up to there, any question? Florence, you are my good friend. You ask questions, I like it. Any questions up to there? Any question up to that point? If there's no question, we continue to say there are two methods. There are two methods. There are two methods. There are two methods, either of which can be used to prepare, a cash flow statement. There are two methods, either of which can be used to prepare a cash flow statement. Number one, we have indirect method, which is the most common, indirect method. Number two, we have the direct method, Number one, we have the indirect method. Number two is the direct method. Then you put a dash and say, these two methods are the same in all aspects, except in operating activities. These two methods are the same in all aspects except in the operating what? Activity. Then when we come to financing activities, in financing activities, they are the same. But when we go to operating activities, they differ. How do they differ? When we go to indirect method, it uses what we call a net income approach, where you begin with profit before tax, you adjust by non-cash item. When we come to direct method, it will have to analyze the cash that the company received or paid to the suppliers, the cash you received from customers and the cash you paid to suppliers and employees for goods and services. Therefore, that is the difference. Indirect method uses the net income approach, while this one is uses the cash paid received from customers and cash paid to suppliers. Let's look at the format. Because that is the most important thing. The format, we are beginning with the indirect method, which is the most common. Format, because without the format, you cannot do the cash flow statement. The first thing you need in a cash flow statement is the format. Therefore, we say we put the format. The format, that is the most important thing in a cash flow. The most important thing is the format. We say XYZ limited. Group statement of cash flows for the year and 31st December 20XX. Group statement. Remember, any financial statement, you start with the title. Which company are you preparing? Which statement are you preparing? Like in this case, we are preparing group statement of cash flow for the year. Which year? 31st December. Maybe we end the year 31st December 20XX. You can put your year 2024 there. Then we go to first section, we say cash flow Cash flow from operating activities. Operating activities, that's our first section of our cash flow. You always begin with operating activities. The first section is operating activities. You underline very well using a ruler. You underline because your competitor is underlining the work very good. And you give us 2 columns of currency, shillings in millions there. That is how we do the cash flow. Shillings in million. Then we are using the indirect method where we use the net income approach. Therefore, you begin with profit before tax. Profit before tax there. You begin with profit before tax. Then you come and adjust by non-cash item. Profit before tax. Then you come to adjust by non-cash items. Therefore, we come to adjust by non-cash items. Let me show you why I'm taking profit before tax, then I adjust by non-cash item. Remember, in a cash flow, I'm only required to determine how much was the cash from operating activities, how much was the cash from investing activities, and how much is the net cash from financing activities. Therefore, in my P&L, I have sales, for example. I have sales, I less cost of sales, then I get the GB, gross profit. I come to less expenses. I'm showing you why we are adjusting by non-cash items. That's what we need to know. Now, when I come to my expenses, I less salaries. I come to less. I less salaries. I less rent. For example, I'm paying rent. I come to less. I come to less depreciation. Of course, you know depreciation is an expense. I less amortization. Of course, you know amortization. I come to less, let me say provisions. And then also finance cost. That is the interest. Then I get profit before tax. Of course, I get profit before tax. I come to less taxation. Less taxation there. I less taxation, then I get profit after tax. That's my income statement. Now, in this income statement, I have this profit before tax. Maybe I said 200. But when you ask me this 200, it is not there. Why? Because in accounting, we use what we call accrual concept of accounting. I reported revenues that I have not received. I reported expenses that I have not paid. I reported expenses again, like depreciation, that are non-cash items. Therefore, here I cannot ascertain how much is the cash, how much is the non-cash. I cannot ascertain. Therefore, in a cash flow, I'm taking this profit before tax. For example, it is 400. For example, 400. Then I want to know how much is the cash that makes up that 400. How much is the cash? Therefore, I'm taking that 400 here. Then I come to add back the non-cash expenses and less the cash, non-cash revenues. Therefore, I come to add back depreciation, of course. It is a non-cash item. Depreciation, I add back. Amortization, of course, I add back non-cash. Impairment of assets, if it is there. Impairment of assets, of course. Impairment loss, let me say impairment loss, of course. I come to add back. Finance cost, of course. I will explain finance cost. It comes in 2 ways. Finance cost comes in 2 ways. I know somebody may ask that, why are you adding back finance cost and I paid? Remember, during the year, why am I adding there? Remember, during the year, you can incur interest. You incur interest, but you don't pay. Therefore, we are going to recognize the whole dividend that we charge to P&L. But at the bottom here, we come to ascertain how much did we pay. Therefore, here first we recognize it as an non-cash item, then we determine how much cash did we pay so that we account for it. Then also loss on sale of assets, or subsidiary, loss on sale of asset or subsidiary. Then we come to less gains. Any gains that we got, any gains, like for example, investment income, you can earn income, but you have not received. Therefore, when I earned, I added as my revenue, but I have not received, therefore it becomes non-cash. Remember here, we just want to know the cash. Therefore, if, for example, I earn revenue, like for example, my good friend Ruth, you say that you are going to pay me 500,000. You want to pay me 500,000. On my part, I can recognize it as revenue because my good friend Ruth needs to pay me. But have I received it? No, maybe you will pay next month. Therefore, today, when I'm preparing my cash flow, it's an non-cash item because I have not received. Therefore, investment income there, gain on sale of assets or subsidiary. When you dispose of a subsidiary, you get a gain. Then we also have profit from associate. It's also non-cash. Profit from associate. Then up to that point, we get cash flow before working capital items. Cash flow before WC. WC is working capital items. Then I come to working capital items. I have three working capital items from your FM. I believe you understand working capital items. Number one is increase or decrease in inventory. Inventory is a working capital item, increase or decrease in inventory. If inventory increases, that is a cash outflow, yes. If it decreases, it is a cash inflow. Why? For example, if in the company, inventory increases from 20 to 30, it means you purchased. When you purchase inventory, it's a cash outflow. Therefore, if it is increases, it's a cash outflow, you less. If it decreases, it's a cash inflow, it means you sold, you received cash, therefore you add. Then increase and decrease in receivables. Increase we less, decrease we add receivables. Then we come to decrease or increase in payables. Increase we add, decrease we less. When payables increase, it means that you are receiving more from your suppliers. It means you are receiving more from your suppliers. When it decreases, it means you are paying out more. Therefore, that is working capital items. Then I get my total there. After I get total there, I come to less finance cost paid, I said finance cost paid will come twice. Like here, total that I have in the income statement, I add back. When I come here, I ascertain how much did I pay. Therefore, I come to less finance cost paid. I also less taxation paid. I less. Then after I less, I come to get net cash flow from operating activities. In column number 2, we call it A. Net cash flow from operating activities. In our second column, we call that A. We call it A. And that is the end of our operating activities. We are done with operation. Now we go to investing activities. Remember, cash flow comes in a chronological order. You don't start with financing, then you go to blah, blah. You start with, always you begin with operating, because you need to generate cash first before you invest. Therefore, you operate, you generate cash, then you start doing investments. Then we go to number two. Number two, investing activities. We say cash flow from investing activities. Cash flow from investing activities. For you, it's a continuation. I'm just shifting because my space here is limited. Therefore, for you, it is a continuation. It's a continuation. Then here, we are investing, therefore, cash paid to purchase asset. Cash paid to purchase asset. To purchase asset. Cash paid to purchase asset, it's a cash outflow. That's a cash outflow. Cash paid to acquire a subsidiary, it is a cash outflow less. Cash paid to purchase intangible asset. Intangible asset is a cash outflow. Cash paid to purchase intangible assets like patents, like copyrights, franchise, it is a cash outflow. Then we go to cash received on sale of assets. That is a cash inflow. When you sell an asset, you receive cash. That is a cash inflow you add. What you are spending out, you less. Then we go to cash received on disposal. Disposal of a subsidiary. I believe we did disposal of shares in a subsidiary. We did disposal of shares in a subsidiary. Of course, we said when you dispose of a subsidiary, you receive cash. Therefore, that is a cash inflow. Then investment income received. Investment income received. Investment income received. Here, we account for the investment income as an expense, as an uncashed item. When we come here, we are going to analyze how much we received. Therefore, here, we are going to acknowledge what is in the income statement, what is in the profit or loss statement. We account for it as an uncashed. When we come here, we report exactly what we received from our customers. Then lastly, dividend received from associate. Dividend received from associate. Dividend received from associate company. Dividend received from associate. Now, in associate, remember, in our income statement, we account for the profit. We account for the profit in our income statement. But do we receive the profit? You don't receive the profit. You wait until this company declares what? Dividend. Therefore, that is the end there. We get the net cash flow from investing activities. In our column number 2, we call it B. In our column number 2, we call it B. That is the end of that section or a division. Then we go to the last division. We have cash flow from financing activities. Cash flow from financing activities. You underline very well using a ruler because your competitor somewhere is making the work very neat, very smart. Here, we are issuing shares to the shareholders to give us money. Therefore, we say issue of shares at a premium. At a premium in our first column, that is our cash inflow. Cash inflow. cash inflow. Then we come to additional borrowings. Additional borrowings. These are loans. We borrow more loans. We borrow more loans. Additional borrowings. When you borrow, you get cash. Therefore, you account for it as a cash inflow. Then we come to repayment of loans. Repayment of loans. If you repay a loan, it's a cash outflow. If you repay a loan, it's a cash outflow. Cash outflow. Then we come to dividends paid to parent shareholder. Dividend paid to parent shareholder, that is cash to the owners of the company. It's a cash outflow. Dividend paid to parent shareholders, less. Then we go to lastly, dividends paid to NCI shareholders. NCI shareholders, that is a cash outflow, less. When we pay dividend to NCI shareholders, that is a cash outflow. Then we come to a net cash flow from financing activities. In our column number 2, we call it C. In our column number 2, we call it C. In our column number 2, we call it C. C. Then we are done with the cash flow. We come to net changes. Net changes in cash and cash equivalent. Net changes in cash and cash equivalent. That one is A plus B plus C. Net changes in cash and cash equivalent. You take your operating activities, investing activities net, and financing activities net. That is what we call net changes in cash and cash equivalent. Then we come to add cash and cash equivalent. At start. Cash and cash equivalent at start, we come to add. That one is when we started the year. How much was there in the balance sheet? When we started the year, how much was available in our balance sheet? Cash and cash equivalent. Then we get cash and cash equivalent at the end. Then that comes to the end of our cash flow. That comes to the end of our cash flow. That is how we prepare cash flow using the indirect method. But we say the difference is only in operating activities. Otherwise, these two are always the same in all aspects. If I'm using indirect method, if I'm using direct method, they are all the same. They are all the same. That is how we prepare cash flow. Now, my question is, when we say cash and cash equivalent, what is the meaning of cash and cash equivalent? Maybe somebody is not understanding when we say cash and cash equivalent. Okay, when we say cash and cash equivalent, it means like this. For example, if I have anything that can be converted into cash quickly, anything that can be converted into cash quickly, we call it cash and cash equivalent. For example, I have short-term investment of 3 months. Short-term investment of 3 months, that is of course a cash and cash equivalent because I'm just going to receive it in the next 3 months. Or if I have bank overdraft of 1 or 2 months, that is a cash and cash equivalent. Or if I have bank balance, that is a cash equivalent. That is a cash. Therefore, cash and cash, when we say cash equivalent, is any investment that can be converted into liquid cash easily with the insignificant risk of their fair value changing. Any asset that can be converted into cash easily with insignificant risk of their fair value changing. We call it cash and cash equivalent. Now, Like, for example, when you purchase an asset, that's not cash and cash equivalent. When you purchase a motor vehicle, that is not cash and cash equivalent, because you may want to sell your motor vehicle, but you hustle for a year even two before you sell it. But if it is investment in money market, you can recover your money in 24 hours. That is a cash and cash equivalent. Therefore, when we say cash and cash equivalent, that is what we mean. Then also, at this point, we are saying group cash flow. Therefore, when we talk of group cash flow, it means there will be acquisition and disposal of subsidiaries. In this cash flow, we are also going to include the acquisition and disposal of subsidiaries. We are going to acquire subsidiaries because it's group cash flow. Of course, we acquire subsidiaries, we dispose of subsidiaries. We are also going to account for associates. As you can see here, we are accounting profit from associate, then we have dividend from associate. Therefore, that is why we are saying group cash flow. It will be including subsidiaries and associates, joint ventures, and such alike. Therefore, that is why we are saying group cash flows. Therefore, in a question, we need to look for a question which has either acquisition of a subsidiary or disposal of a subsidiary, and know how to account for that in the group cash flow. Therefore, all these items, we need to know how to get them. We need to know how to get them. But now for us to learn them as workings, we are going just to use a question without wasting much time. We are going to just use a question and see how we get several items here. Because in a cash flow, at some point, examiner will want you to determine one item or one, like for example, here cash paid to purchase asset. Examiner will not just tell you directly that during the year, the company purchased an asset of 200 million. Examiner will not tell you that. You have to determine from your calculations and get that 200 million and get that 200 million. That will be okay. Therefore, I want just to use a question, and the question I want to pick is the question on that has both disposal and acquisition of the subsidiary. The question that has both disposal and acquisition of the subsidiary, so that we use one stone to kill two birds. Instead of doing a question that has acquisition of a subsidiary, then we go to another question that has disposal of a subsidiary. I just want to use one single question and see how we acquire a subsidiary in the balance sheet, in the cash flow, and how we dispose of a subsidiary in the cash flow. I believe up to that point, we are okay. Up to that point, we are okay. Therefore, I want us to look at the question of November 2019. November 2019, I'm choosing that question because it has both acquisition and disposal of a subsidiary. That is why Mwalimu is choosing that question, because it has both acquisition and disposal of a subsidiary. When we do that question, I believe very much we shall be okay. We shall be okay because it has both. November 2019, question number 4. November 2019, question number 4. If you are there, you just say yes to Mwalimu so that we continue together. If you are already there, you just say yes to Mwalimu so that we move together. Thank you very much, Ruth. Thank you very much. You are there. November 2019, question number 4. Mwalimu is already there. Edwin, thank you very much. This question reads, I will read through the question. Question number 4, the following financial statement led to Makongeni Group for the year ended 31st October 2019. We end our year on that 1st October 2019. In our cash flow, you will be given two balance sheets, the balance sheet of the previous year and the balance sheet of the current year, so that you compare in between what happened. Like you can see, in the previous year, our PPE was 200 million. In the current year, our PPE is 500 million. Therefore, we need to ascertain what is causing the increase in PPE. Is it that we revalued? Is it that we purchased? Or what is causing the increase in PPE? That is why examiner will always give you two balance sheets. The balance sheet of the previous year, those are the balances, and the balances of the current year. Now, let's go through it. We have property, plant, and equipment. When you check in the previous year, it was 65. In the current year, it's 10,180. Therefore, there is an increase. We need to ascertain, was it a revaluation or what happened? Then we have goodwill. Goodwill in the previous year is 74. In the current year is 7720. We need to check on goodwill. Did we impair goodwill or we acquired more subsidiaries? Then investment in associate. It will help us determine the dividend we paid to associate. Then inventories. We have current assets, inventories. Inventories, we check on the increase or decrease. Like when we check in our inventories, previous year it was 1740, current year it's 1880. Therefore, we are certain, is it increase or decrease? It's an increase, but of course we are going to include the inventory of subsidiary acquired and inventory of subsidiary disposed. The receivable the same. Short-term investment, this cash and cash equivalents. We have cash and bank balance. Ordinary share capital. In the ordinary share capital, you are going to ascertain, did you issue any shares? Like when you check in our financing activities, we said issue of shares at a premium. Therefore, how do we know that we issued shares? We check in the equity ordinary share capital. Like in this one, previous year is 6 million, current year is 6 million. It means that during the year, we did not issue any shares. Revaluation, retained earnings, non-controlling interest. Then bank loans, we have bank loans there. Previous year 1,200, current year 2,000. It means that we did additional borrowings. We borrowed more. Bank loan, we borrowed more. Deferred tax, we need to check if we paid or not. Current liabilities, trade payables, you check the increase or decrease in payables, then current tax there. Then we have income statement, we have revenue, operating expenses, and profit from operations, gain on disposal of a subsidiary, finance cost, share of profit associate, profit before tax, income tax expense, profit after tax for the year. Then other comprehensive income, we have revaluation gain on property, other comprehensive income in of associate, total comprehensive income, then profit for the year attributable to the owners of the parent, then non-controlling interest, total comprehensive income there to owners of the parent and non-controlling interest. Additional information, note number 1. During the year, Makongeni Limited acquired 80% of ordinary share capital of Razaka Limited, paying cash consideration of 6 million. Now, when you go to under investing activities in our format, we reported cash paid to acquire a subsidiary. We reported as a cash outflow. Therefore, here we have 6 million. The non-controlling interest holding was measured at its fair value of 1360 million at the date of acquisition. At the date of acquisition. Then we continue. The fair values of the net assets of Razaka Limited as at the date of acquisition comprise the following. Therefore, we have property, plant, and equipment. When we are checking increase or decrease, of course, we include the assets of the subsidiary acquired and disposed. Note number 2. During the year, Makongeni Limited also disposed of entire 60% ordinary shares in Salama Limited. The acquisition had been acquired several years. The subsidiary had been acquired several years ago for cash consideration of 2.4 million. We acquired a subsidiary many years ago, at the purchase consideration of 2.4 million. The non-controlling interest holding was measured at its fair value of 12.80 million as at the date of acquisition, and the fair value of Salama Limited net assets was 29.20 million. Goodwill on acquisition of Salama Limited had not suffered any impairment loss. At the date of disposal, the net assets of Salama Limited had carrying values in the consolidated statement of financial position as at the set out below. Now, these are the net assets that we disposed. Now, when we are checking on the increase or decrease of any item, we also include them, property, plant and equipment, inventories, we include those items to ascertain. Number 3, the short-term investments are readily convertible into known amounts of cash, and there is insignificant risk of their fair value changing. Examiner is talking about the short-term investments in the balance sheet. He's just telling us that we can convert into cash quickly with insignificant risk of their fair value changing, which means it's already cash. It's already cash. Number 4, depreciation of 1540 million was charged during the year. Plant with the carrying amount of 1 million, 1 million, was sold for 1.1 million. The gain on disposal was recognized in the operating profit. Some properties were revalued during the year, resulting in a revaluation gain of 800 million being reported. Ignore deferred tax on revaluation of property, plant, and equipment required. Consolidated statement of cash flows for the Makongeni Group for the year ended 31st October 2019, using the indirect method in accordance with IAS 7 statement of cash flows 20 months. Now, this is what we want to use as an example of how you prepare a group cash flow. But before we start serious discussion on this question, I pray that we have a break of 5 minutes so that we refreshen up. When we begin, I don't want us again to break. Therefore, just have a break of 5 minutes. Break of 5 minutes. Then we come back, we continue with the discussion. Thank you very much. Let's continue with this question now. November 2019, question number 4, and see how we prepare the cash flow. Now, the cash flow is the easiest thing that you can ever do. It's the easiest thing that you can ever do. Therefore, let's see how you do it. We said, this is, we are using indirect method. We say Makongeni Group. Makongeni Group. Statement of cash flow. Of cash flow for the year. The year ends that 1st October 2019. That 1st October 2019. That 1st October 2019. Then we start with the cash flow from operating activities. Cash flow from operating activities, like that, you underline very well, like Mwalimu there. Then you give me 2 columns of currency, shillings in millions, always in a cash flow. You make it very neat. You give me 2 columns of currency. Then, because we are using indirect method, we go to profit before tax. Profit before tax. Now, profit before tax, that one is always a free mark, because once you have the income statement, you will get it directly. Like, for example, this one, we just go to our income statement directly. We take 4460. 4460. We get a mark on it. It's a free mark there. 4460. Then we come to adjust by. adjust by non-cash items. We come to adjust by non-cash items there. Item number 1 is depreciation. Item number 1 is depreciation. When you check in this question, my good friends, we were given depreciation in note number 4. Depreciation of 1540 million was charged during the year. 1540, I come to add back 1540. Very simple like that. But remember, sometimes examiner will not give you the depreciation. How do you get it? Therefore, what I can advise you, let me advise you on something. You leave one page for our cash flow. If it is A4, you leave one full page. Then we go to working so that we see the workings on how to find some items if examiner has not given you directly. Like sometimes if depreciation has not been given, how do you get it? Workings, we say workings. Workings, 1, depreciation. If depreciation has not been given, how do you get it? You take your balance brought down. That is accumulated dip of the previous year, accumulated depreciation of the previous year. Examiner, if he has not given you this depreciation, he will give you the balances of depreciation from the previous year and the current year. Therefore, I come to add subsidiary acquired. That is dip. Subsidiary acquired. If you acquire the subsidiary, you come to add depreciation. I come to less subsidiary disposed. Depreciation of subsidiary disposed. Then I get my total there. After I get this total, I compare with balance carried down, accumulated dip of the current year. I compare the difference is dip for the year. That is how you get it if it was not provided. If it was not provided. After we do this question, I will not imagine if any question of cash flow will defeat you, because we are doing any item that we need to report and it has not been provided. We look for how can you get it. And if you master this, then believe me, you are going just to be a champion in the cash flow in the next few hours. Therefore, this examiner was wishing us success. We go to amortization. Number item 2 item is amortization. Amortization, how do you get amortization? Number 2, amortization. Amortization compare intangible assets in the balance sheet. Compare intangible assets in the balance sheet. Like for example, I have 2019, 2020. 2018. I go to the balance sheet under non-current assets, I check intangible assets. This one is 2,000. This one is 2,500. As you can see, in the previous year, it was 2,500. In the current year, it is 2,000. That one will report amortization. But if it is the reverse, intangible asset, this one is 25, this one is 2,000. It means we purchased, we take it to investing activities, what we purchased. When you check in our investing activities, I already indicated there, cash paid to purchase intangibles. Therefore, if intangible asset in the balance sheet is increasing from 2,000 to this one, it is. But if it is reducing from 25 to 2,000, we report it as amortization, good friends. That is what you do. This one, we don't have it. Therefore, I put a dash and move on. Number 2 is impairment. Impairment loss. Impairment loss, you compare goodwill. Impairment loss, you compare goodwill. Let me show you how you compare goodwill. Working number 3, impairment loss, you compare goodwill. Impairment loss, you compare goodwill. This one we compare goodwill. I will take my balance, brought down, that is goodwill. I come to add acquired, subsidiary acquired goodwill, I less disposed, that is goodwill. Then whatever I get, I compare with balance, brought down, carried down, balance carried down, my goodwill. Therefore, the difference from what I expect and what I have at the end becomes my impairment. Like when we use this question under non-current assets, I believe you are checking the question under non-current assets, we have impairment. Previous year it is 74. I put 74 there. Then current year is 7720. 7720. I put it there. Then I go to subsidiary acquired. I acquired the subsidiary. How much was the goodwill? Now, goodwill in Razaka. Goodwill, Razaka Limited. We acquired Razaka. Who can give us goodwill in Razaka Limited? Goodwill in Razaka. Purchase consideration. Purchase consideration was 6 million. Note number 1. Note number 1. During the year, Makongeni Limited acquired 80% of the ordinary share capital of Razaka Limited, paying cash consideration of 6 million. NCI, fair value NCI, was 1360. When you check there, it says the non-controlling interest holding was measured at fair value of 1360. Therefore, NCI, we have it there. I get 70 what? 360. That is my total investment. Then I come to less net assets acquired. Net assets, which is in note number 1, net assets 5960. 5960. Therefore, my goodwill, my good friend Ruth is saying 1400. My goodwill is 1400. I come to add 1400 there. Then I take Salama Limited. I acquired Salama Limited. Note number 2. What was goodwill in Salama Limited? Goodwill, Salama. Examiner did not give us the goodwill there, we compute. We compute. Purchase consideration in Salama. Purchase consideration in Salama, note number 2, I believe you are reading note number 2. We acquired Salama 60% at 2.4, 2400. That was the purchase consideration long time ago. Then what was the fair value NCI? Fair value NCI. Examiner told us that the non-controlling interest holding was measured at fair value of 1280. Note number 2, 1280. When I add, I get 0, 8, 6, 3, that's 680. That's 680. That is my value. Then I less net assets. Net assets acquired. Net assets acquired. And the net assets acquired were 2920. 2920. When you less 0, 6, 760. 760 is our goodwill. Therefore, I come to less 760. I less 760. Therefore, I expect my goodwill to be how much there, my good friend Ruth? My goodwill to be how much? I expect that 74 plus 1400 minus 760. I expect 80, 40, but at the end, I have 77. 320. That is impairment loss. 320, because goodwill is reducing, impairment loss of 320. That is how you get it if examiner has not given it. Now, this one has long workings. Why? Because we have acquisition and disposal of a subsidiary. In many cases, we only find acquisition or disposal. Therefore, that is how you get impairment. We go to the next item is finance cost. Finance cost. Finance cost is a free mark because you just directly get it in the income statement. That one will not require working. Finance cost will not require working. You just get it directly in the income statement. Who can give us the finance cost? As we check in the income statement, it is 140. That is a free mark. That one is a free mark. That one is a free mark. Then I come to, in the income statement, we have gain on disposal of a subsidiary. Gain on sale of a subsidiary, 400. Remember we said gains we less, losses we add. Gains we less, losses we do what? We add. Therefore, I have a gain on sale of a subsidiary. Gain on sale of a subsidiary. If it was a loss, you add back because it was to be subtracted. Then also I have gain on sale of asset. Who can give us the gain on sale of asset? From note number 4. Ruth, can you help us? Gain on sale of asset. Depreciation of 1540 million was charged during the year. Plant with the carrying amount of 1,000 million was sold for 1.1. Therefore, the gain is a 1 minus 1,000. We have 100. I have the gain of 100. I less gain of 100. I less there. Then next is profit from associate. From associate or joint venture. If it is a joint venture also, 460. We less 460. We do what? We less 460. We less 460. We less. Because it was a profit, if it was a loss, you add back. If it was a loss, you add back. I believe those are the items that affect our this one. We get cash flow before working capital. Cash flow before working capital. Cash flow before working capital. I believe you are doing it quickly. I will take 4460. $55 there. You get 55 there. As you can see up to this point, the only working we have done is on impairment. And it's not a serious working. If you are just a good student, you get it. The only serious working is this one. This one, we are just picking them from the income statement. Nothing else. Therefore, cash flow, you can get a lot of marks there. Then we go to check working capital items. Inventory. Inventory. Receivable and payable. We check on increase or decrease in receivable, in inventory, and now let me show you how you get those items quickly. How you know if it is increase or decrease. How you determine them quickly. How you determine them quickly. Let me show you. We say here inventory, receivable, and payable. And payable. We want to see how you get those three items quickly. You are going to take your balance, brought down. That is inventory, receivable, or payable. Let me start with inventory. Let me begin with inventory. Let me begin with inventory. Balance brought forward is 1740. Then subsidiary acquired. I add subsidiary acquired. I acquired Gazaka. What was inventory? 600. I add subsidiary disposed. Disposed we less. If you sold a subsidiary, you less. I sold 660. Therefore, what should be my inventory? What should be my inventory? Good. What should be my inventory? 1740 plus 600 minus 660. It should be 16 what? 80. It should be 1680. Then I compare with balance. At the end, balance carried down from the balance sheet. You compare with the balance carried down from the balance sheet. Of course, it's how much? 1880. Therefore, there is an increase. There is an increase. Increase of how much? Of 200. If I'm not wrong, increase of 200. Therefore, I just come, if it is increase, we less, 200, we less, like that. That's how you determine that. You take the balance brought forward, subsidiary acquired, subsidiary disposed, you less. Then we go to the next, these items. Receivable, 1320. Subsidiary acquired receivable, 960. Subsidiary disposed, 480. Whatever we get, we compare with balance at the end, which is 1560. We compare with 1560. Is it a decrease or increase? Is it a decrease or increase? That is 1320. I get 1800. As you can see, our receivable should be 1800. But at the end, we have 1560. Therefore, how much is the decrease? 240. 240 decrease. Decrease we add. Decrease we add. It means that when the receivable decreases, it means that we were paid. Therefore, we add is a cash inflow. Is a cash inflow. Then we go to payables. Payables quickly. Payables. Payables, I'm taking 2,900 from the previous balance sheet. Subsidiary acquired, 880, you add. Subsidiary disposed, 320, subsidiary disposed is 320 with less. We less, then whatever we get, we compare with what we have at the end, 32. We compare with 32, what we have at the end. We just compare it like. Therefore, it's 2,900. $34.60. I expect $34.60. I expect that 460, but at the end I have 32. Is it a reduction or increase? That is a reduction, of course. $260 decrease, 260 decrease we less. It means we paid. Decrease we less, it means what? We paid. It means we paid, therefore we less. Decrease. Therefore, these are free marks. In an exam, those are free marks. Those are free marks. You're just using that one is a free mark. Don't fail me, it's a free mark. It is a free mark. Then we get our total here. We get our total. That is 5,500 minus 200 plus 240 minus 260, 5280. 5280 there. I come to less finance cost. Finance cost paid. I said finance cost will appear twice. The one as an non-cash item and what we paid. How do we get what we paid? Finance cost. How do we get finance cost paid? I will take balance, brought down, that is interest, payable, accrued interest. I come to add subsidiary acquired interest. I come to less subsidiary disposed interest. Then whatever I add interest for the year. Interest for the year. Then whatever I get, I compare with balance, carried down, accrued interest, accrued interest. That is how you get that item. If I'm going faster, you tell Marim you are going faster. If I'm going slowly, you tell Marim you are very slow. Therefore, don't suffer in silence. Speak out, speak up. Don't suffer in silence. Or if the speed is okay, also you tell Marimu, the speed is okay. Don't suffer in silence. That is how we get that item. Therefore, using our question, is there anything of accrued interest? When you take in the balance sheet, it's not there. There is no accrual. In the subsidiary acquired, there is no interest. In the subsidiary disposed, there is no interest. Then what does it mean? Whatever we charged here is what we paid. Therefore, it appears twice. Whatever we charged there is what we paid again. As simple as that. Then we go to less tax paid. Tax paid, tax paid, tax paid. Let me show you the working for tax paid. Let me show you the working for tax paid. Tax paid. You take the balance brought down, that is deferred tax. Current tax. Current tax. Then we add subsidiary acquired tax. We add subsidiary acquired tax. We add subsidiary, we less subsidiary disposed tax. Recoverable tax recoverable, less tax recoverable. If there's tax recoverable, you less tax recoverable. Then we add tax for the year. Tax for the year you add, you give me total. Then we compare with balance, carried down, deferred tax. Then current tax. Therefore, using this question, I want you, my good students, we are six there. I want you to give me this item using this question. I want you to give this item. I'm giving you 5 minutes. I'm giving you 5 minutes to give me this item. 5 minutes. 5 minutes using this question. Anything, my good friends? Anything? Anyone? Anyone? Okay, let me see if it's possible. Balance brought down, deferred tax, we check in the balance sheet under non-current liabilities. We have 420. Current tax in the previous balance sheet, 1440. Subsidiary acquired. You check in the subsidiary acquired, we acquired 160. Subsidiary disposed, there is nothing. Tax recoverable, you check in the income statement if it's the tax recoverable, there is nothing. Tax for the year is 900. Therefore, what do we expect there? Then I go to the balance, carried down, current year is 600. Then we go to current tax of current year, 1600. Therefore, we compare these items. We are going to compare these items. Here it is 2920. I compare 2920 with 22. That is 720. The difference is 720. Thank you very much, Ruth. 720. Thank you very much. 720. That is what we paid as tax. Then we are done with our operating activities. We say net cash flow. Net cash flow from operating activities. That is our number one. Net cash flow from operating activities, which is 5280 minus 140 minus 720. I'm getting 4420. Of course, it's a positive 4420. That is the end of our operating activities. We get 8 marks out of there. You get 8 marks. We get 8 marks out of that. We get 8 marks. That is very easy. Very easy if you are a very willing and serious student. If you are willing and serious, it is very easy. If you are willing and serious, very easy. We go to investing activities. Let's go to investing activities. We go to investing activities. Investing activities. We say under investing activities, cash flow from investing activities. Cash flow from investing activities. Cash flow from investing, this net cash flow from operating, we go to cash flow from investing. This one we have cash paid to purchase assets. Cash paid to purchase asset, cash paid to purchase asset. Cash paid to purchase asset. This one, we check working, we check on asset movement. Asset movement. Cash paid to purchase asset, you check on asset movement. Asset movement. How do you check on asset movement? You take your balance, brought down. That is PPE from the previous year. PPE from the previous year. You come and add subsidiary acquired. PPE of subsidiary acquired. You come and less subsidiary disposed. PPE. You come and less asset sold. PPE asset sold. You less PPE of asset sold. We come and add revaluation gain, revaluation reserve. We add. We less finance lease. Finance lease, if we acquired an asset through finance lease, we less. Through finance lease, we less. Then we come and less depreciation for the year. Depreciation for the year, whatever I get, I compare with balance carried down. PPE. We compare with balance, the difference is cash paid to purchase asset. The difference is the cash paid to purchase what? Asset. Again, Marim is giving you an opportunity, 5 minutes, again to give him that item. 5 minutes opportunity again to get the item. Give me the item. We take our balance brought forward PPE. Of course, from the balance sheet, it is 65. It is 65, of course, there. Of course, it's 65. Subsidiary acquired. We acquired Razaka 5120. Of course, you add 5120. Then we disposed of Salama, of course, 29 PPE. We less. Also, we sold the asset in note number 4. Examiners told us that plant with a carrying amount of 1,000 million was sold. 1,000. 1,000. We less 1,000. Then we have revaluation. In note number 4, examiner told us that some properties were revalued during the year, resulting in a revaluation gain of 800 million being reported. Therefore, revaluation of 800. And let me tell you something on revaluation. Listen to Mwalimu. Listen to Mwalimu on the revaluation. How do I know that the asset was revalued? I will go to the balance sheet under equity. Under equity. Under equity, let's go under equity. In the previous year, we have revaluation surplus. In the previous year, 21. In the current year is 3. Therefore, it is 23 million minus 21 equals to 900. If there was no note number 4 about the concerning revaluation, this is what you report. This is what you report if there is no note number 4. But if examiner has said properties what this was revalued was reported, then that is what you take. That is what you take. That is what you take. Then finance lease, we don't have finance lease in this question. Depreciation of the year is 1540. 1540. Of course, we get our balance. Then we compare with the 10180. The balance at the end is 10180. After we get the difference with the total there, Mwalimu is taking 665 plus 5120 minus 1,000 plus 800 minus 1540, 6980. When you compare 6980, 3,200. Therefore, there is 3,200. That is cash we paid. I write there 3,200. but in bracket there. That's how you do cash paid to purchase asset. This is a standard working. There is no question that will defeat you if you are using this working. Listen very carefully. There is no question that will defeat you if you are using this working, because all this item is what the examiner can ask you in an asset movement. Therefore, I beg to stop there for today's class. I beg to stop there. When we meet in our next class, we shall continue with other items, or at your own free time, you can fill them because you have them on the format. Using the workings we are doing, including subsidiary acquired, subsidiary disposed, you can do them. We meet in our next class on Monday. In our next class on Monday, as we finish up the question, then we go to the next question. Thank you for your time today. Bye-bye.